Hello, how are you guys doing today? My name is Anthony Murray, and I am your host today. As you see, my colleagues, Miss Tanya and Mad Flo, they're not with us today at this time, I should say. But let me just tell you a little bit about ourselves. You know what? We're here because you are there, right? This is Financial Sense, and I'm your host today, Anthony Murray. So, what are we going to talk about? Well, we're going to talk about a lot of different things, but more importantly, we're going to talk about qualified and non qualified monies and where to put these monies, when to put them, and what happens when you use non qualified monies, where do they come from? And when you use qualified monies, where do they come from? We have a special guest with us today. His name is Mr. Terry Clark Sr., and he's been in the industry, finance industry, 30 plus years. And listen, there's just a lot that you guys are going to learn today. There is a whole bunch. So I want to encourage you to stay tuned, stay there, call somebody, let them know that we're here. And you know what? It's going to be a blessing to you today. You don't want to miss it. Now, as you see in the background, we're in part of my messy library, but it's all right. It's all right. It's all good. This is going to be a beautiful thing today. You don't want to miss it. You want to take notes. Now, if you have money that you've been trying to figure out what to do with it, or you have money and you're trying to figure out why you're getting taxed so, well, this man is going to tell you why. Okay. So I want to bring our guest on right now. And you already know who I am. I've been in the finance industry off and on since 19, ooh, boy, as I think about it, 1983, 84, in that range, somewhere back in there. I went to school for insurance and real estate and focused in on real estate for 12 years. I worked with a company called Mutual of Omaha in insurance and worked with another company called Edward Jones. And now I'm with World System Builder. I love it. Why? Because World System Builder has such a wide platform. All right. A wide platform. So, guys, listen, stay tuned. Tanya's going to be coming on pretty soon. You know Tanya Scott Pilcher. Yes, my friend, my buddy. All right. She is on the road. She's in Texas. And I'm just glad that she's able to be with us for a few moments here. All right. Tanya.
What's going on? I am so sorry. I had so much going on. You all just would not believe. But this isn't even right yet. But hey, I see my friend Terry Clark. He is already here. Hey, Terry,
Yes.
how you doing?
Awesome. How are you?
I am excellent. I'm going to go back out for a minute. Welcome, everyone. Let's go ahead and get things started. My friend Terry Clark is here to talk to us in reference to the secrets of wealth, right?
The secrets of the wealthy.
Yes.
That's right.
The secrets of the wealthy. You know, I'm interested in knowing, but I thought I knew a little bit. But when I heard that topic, I was like, oh, yeah, it's time to go back to class. So with Mr. Clark, we are looking forward to it. Why don't we start off with why don't you just tell us a little bit about yourself, how long you were in the industry. I know I mentioned it, but tell us a little bit about your background.
Well, thank you so very much. And thank you for the invitation. And thank Tanya again for bringing me to your studio, sharing with me your vision and what you guys are attempting to do in terms of trying to educate our community. I'm just so pleased. Again, as mentioned, I'm Terry Clark Sr., retired. And yes, I have a long career in the financial services industry. Prudential hired me out of Morehouse in 1974.
Wow.
So you're thinking about that. That's over 40 plus years ago. And I retired from this industry after 45 plus years, and then decided to return to this industry as a CEO, just basically educating people. So my wife and I, we are co-founders of a national marketing company.
Wow.
And what we do is show people how to grow money.
Mm-hmm.
And so again, understanding the secrets of the wealthy as our theme. And basically that secret of wealthy really is IRS.gov.
Okay.
Many folks are just not aware of one of the greatest websites in the world is IRS.gov. So I tend to ask people we work with, when was the last time you visited IRS.gov? Well, do you know anything about the tax codes of America? Most folks have no
internet is kind of in and out there. Okay.
That's and so right. Just understanding the tax codes of America is just a little bit, and particularly as it relates to money. And then, of course, you have two sets of codes that you mentioned in the beginning. You have your qualified codes or pre-tax codes. And then, of course, you have your non-qualified codes, of course, post-tax codes. Mm-hmm, so just understanding qualified pre-tax versus non-qualified post-tax. And so those are just, two ways to say this. Those are just two of the tax codes in America, but they're so huge, and we tend not to be knowledgeable about that, and we only think there's only one way to grow money, and that's usually through the pre-tax strategy. Those codes like 401k or IRA, those at 403b. Okay, those are those qualified codes. We tend to get that through our employer a little bit, and then but we have nobody out there that's educating us on the non-qualified side.
Okay.
So I'm just very pleased to see you guys talking about the non-qualified side, understanding that is one of the true secrets of the wealth in America, and just understand that. So I tend to start my conversation off with just, always understand your tax bracket. How many folks truly understand their tax bracket?
Mm-hmm.
And so you think the average consumer, the average family is in approximately a 30% federal tax bracket.
Okay.
And so they really don't quite that. And then, of course, you got to add, in most states, you got a 6% state tax.
Okay.
Then, of course, folks forget about they're paying 7.65 FICA percent. So exactly. 7.65 FICA. So what are those three numbers? 30% federal, 6% state, 7.65 FICA. What is that? 43.65 or so?
That's right.
Then you go to the store. What you're paying? What, a sales tax?
That's right. Yeah.
Another 6 or 7%, right? So where are you now? You're there in that 49, 50, 51% tax bracket.
That's right.
So my point being, that's a very expensive dollar.
Yes.
So if you're in a 50% tax bracket, you have to earn $2 to net $1 to go shopping.
Okay.
Or if you're trying to build wealth, same thing, of course, So again, very expensive dollar. So I would say I understand how on the qualified side, you better grow that money pre-tax before you pay that 50% tax bracket.
Mm-hmm.
That pales in the long run because on the back end, all that money is taxable. So you hide that money through that qualified window on the front end. That's the seed going in. But then when you get ready to reap the harvest coming out,
now you got to pay taxes.
You got to give the tax man that 50% on the back end. So you invested $100,000 going in, and let's assume you save 50% on that money. But then now your harvest, you got $500,000 on the back end, and you're going to give the tax man 50% of that money. So you save 50% going in on $100,000, that's $50,000. But then you pay 50% on the money coming out. On that $500,000, that's $250,000.
All right, hold on. Wait a minute.
Hey, that's a lot of money.
Wait a minute. There's a lot of zeros there. A lot of zeros. All right.
Okay, so you're talking too fast, Mr. Clark.
Okay. All right. Now let's slow this down just a little bit. Okay. Now, the money you're talking about right now is qualified monies.
Pre-tax.
All right. So they've already been pre-taxed. That's pre-taxed money.
You're talking about my 401k stuff, right?
All right. That's correct.
All right. So Now they're going to pay taxes on the back, and plus, in most 401ks, they got to pay. Well, all of them that I know of, they have to pay that fee, that service fee.
Yes.
All right, aside from the taxes.
That's correct. We haven't even gotten into the fees.
We haven't even gotten into the fees yet. All right, so let's back it up a little bit. All right, now let's make sure people understand. We are talking right now. You're talking about qualified monies. That's what they call it.
Yes,
qualified monies. All right, under that bridge falls what are the titles to the qualified money?
But those codes on that side, of course, so the ones that we are familiar with, of course, you got your 401k code, and of course, you got your IRA code, you got your 403b code, right?
Right.
You got your 457 code.
457, right?
That's correct. So those are all pre-tax codes that we understand how to grow money pre-tax. And that's a nice bucket to put money in. No problem with that. That's an awesome bucket.
Right.
And that most people have through their employer window. But we are not being educated about the other window, the post-tax window. And on that side of your net, when you bring the money you bring home, again, there are tax codes there's a bucket on that side as well.
Okay.
So you really should have two buckets. You should have a qualified bucket, a pre-tax bucket. Then you should have a non-qualified bucket, a post-tax bucket. And that code on that side is IRS code 7702.
Okay.
So just understand the IRS code 7702. Anyone that just takes that code and Google that code can kind of get an understanding of how of the post-tax side.
All right.
On that side, that code is very specific. It basically says that any money taken in the form of a loan is tax-free.
Okay.
Folks are not aware that that code applies to our daily lives. Most folks that own a home, they borrow against their house. That loan is tax-free.
Right.
Or if you ever borrowed against your car, borrowed against a life insurance policy, right? Okay, so why? Was that taxable or tax-free money?
Tax-free.
That loan was tax-free. Under what code? Under what code?
I don't know.
Same code.
7702.
So that loan against your house, that's covered on the IRS code 7702.
All right.
That tax-free loan against your car is covered on the IRS code 7702. The same thing applies. That tax-free loan against your life insurance policy is also IRS code 7702. So people are building wealth through their insurance policy, millions of dollars, and plus the growth on that money, the interest earnings on those dollars. Okay, and so that harvest on that side, then they pull that money out through tax-free loans.
Okay,
so it's just a strategy where you have a chance to build equity and then access the equity, the principal, and then access the interest as well. All of that, those dollars tax-free.
Oh, wait a minute, back up. Hold on, wait a minute. Now we switched. We're no longer talking about qualified monies.
That's correct.
We're talking about non-qualified.
We're on the other. We're in the other bucket. Yes.
All right. Now we're talking about non-qualified, and it's good. Basically, what you were saying earlier, it's good for people to have both buckets.
That's correct.
The non-qualified and the qualified. All right. So in the non-qualified, when people need to borrow that money, they're not paying any taxes on it.
That's correct. First, of course, you have a withdrawal option of your principal. You have to understand, of course, how that code works. You can withdraw your principal tax free.
All right.
How do you access the interest? So if I've invested $100,000 again, and I've got a $500,000 growth in my fund at the end of 30 years, okay, that's a $400,000 gain, interest gain. So if I put in $100,000 over 30 years, $500 a month,
Mm-hmm.
And now that that money has grown to $500,000.
Mm-hmm.
I'm now ready to eat some of that money.
Mm-hmm.
Okay, I can withdraw my $100,000. My principal, that's your base. You can
Right.
withdraw your base tax free. That's your money.
Right.
You put that money in there after tax, so it's still after tax. It's still tax free.
Uh-huh.
Right.
But then you're sitting on $400,000 of gain.
Wow.
Okay, so now how do you access that money?
Right.
So if you withdraw, if you use to withdraw your option on any of that money, then those dollars are now taxable. But
Right.
if you use the 7702 option, the loan option, and you borrow that $400,000, that entire money, that entire check, that entire $400,000 is tax free.
Wow.
Okay, but how did I grow that money? Where did I put it in order? Because I only put in 100 and got 400, or I put it somewhere and got something out. Where did I grow that? Now you gave me some slides to put up. Do I need to put one up now, or?
Yes, you do. You should have the first one up. Of course, that was the 2 ways to grow money.
Mm-hmm.
Okay, let me see if I can get that one for you. Let's see.
We can talk a little bit about where do you put that money, because that's the next story. So it's just, again, you hope that your advisor, it comes back to your advisor. Who's your advisor? If your advisor is not giving you both stories, then you need another advisor.
Right.
Yes.
Okay.
Again, so
There you go.
Yeah, thank you so much. So building a financial legacy, again, understanding the 2 ways to grow money. You can see on the left side, the qualified side, we talked about, pre-tax and the pre-tax seed going in. And there you have, of course, those traditional codes that most folks are familiar with. Of course, you have the IRS code, the 401k or the 403b. Those are just traditional codes. And then on the other side, you have the non-qualified side, and that bucket, of course, that seed going in is post-tax. So, if you are a farmer and you're growing 2 crops, on one side of the street you got your qualified crop.
Right.
On the other side of the street you got your non-qualified crop.
Mm-hmm.
So again, one crop on the left side, that crop is taxable. That harvest is taxable. So when you go to eat, you're going to pay taxes on that entire harvest. So you planted those little tiny seeds in the ground, and then you just watered it over the years, and then it grew, and now you got this beautiful harvest. And so now the taxman is sitting there. He's going to, and with his hand out, of course, he's going to eat just out of your harvest with you.
So, Terry, I think most people forget that with that retirement money that they get, from their 401k, that they're going to have to pay taxes on it. I think they all forget, that once I get retired and I start pulling from my 401k, that I have to pay taxes on it. I believe we all forget that.
It's a nightmare.
Yes. Right.
You're absolutely correct. That's the nightmare in America for retirees. Talk to any retirees today and ask them about their tax bracket. Most folks are in the highest tax bracket of their life after they turn 65 and they touch that qualified money. Now, all those years they've been told that, well, you're going to be in a low tax bracket when you retire. Says who? Okay, that's not the case. And that very rarely happens because you've already paid for the house. You don't have no deductions. You don't have any write-offs. All you have now is just a tax system looking at you, way to just eat your money that you've been sending away, that you've been putting away all your life. So again, unfortunately, it's a misinformation in the marketplace, and we just need to understand the power of tax-free money. We just need to recognize you need to have more than one bucket. So again, taxable, pre-tax versus post-tax, taxable versus tax-free. Again, 2 ways to say the same thing. Now, you talked about where's that money going to go? How are you going to grow that money in what? Well, of course, you have that money in the market. Of course, on the qualified side, we're familiar with that. And we know those funds are at risk. Or then on the non-qualified, what you may be not aware of, now you can be indexed to the market. Most folks have no clue what being indexed to the market is.
That's right.
That's a whole different market strategy that allows you to be indexed to the market, not in the market. So
Right.
if you can get money, if someone mentions to you, you can get market growth at no risk. Okay, most folks really are not truly, in my opinion, investors. So
Right.
what is the definition of an investor? The definition of an investor is someone who can afford to lose their principal if
Mm-hmm.
the market drops. So how many folks do you know that can afford to lose anything if the market drops? Okay, so truly most folks are not investors. And so in my opinion, if you don't have $100,000 in the bank, 9 times out of 10, you're just a saver.
Okay.
And so how many folks you know with $100,000 in the bank? So again, I just call those dollars, for me, those are kind of dollars are just monies you need to have 6 months of income or 12 months of income. And depending upon your income, 6 months of your income could be $100,000.
Mm-hmm.
Or 12 months of your income could be 100,000. So then that's just having savings. Those dollars are just for saving purposes. But then what about your investment dollars? And so understanding index.
Matter of fact,
Mhm.
she's going to be back. She's in a hotel or somewhere, and she's traveling on the road. But I want to, well, I want to do like this for a moment, if I could. Just the only way I know how to say it,
Yes.
because we're talking qualified and we're talking non-qualified. All right, most people are familiar with qualified and very comfortable with qualified. All right. But what they don't realize is because they're so comfortable with it that there's other options out there that could really help grow and protect their wealth.
Mm-hmm. Yes.
And so when we look at the 401, the 403, the 457, and things like that, now we're looking at money that they're going to get taxed. There is growing tax deferred, and a lot of people don't remember that word deferred. The taxes are deferred. They still have to pay tax. All right. So there's a lot of people, they enter into retirement and they still have that money in their 401, that 403, that 457. They could do a in-service rollover, could they not, to a non-qualified and save money?
There is some options there. Most folks are really not educated about that, and so you got to look at those dollars and see what kind of tax bracket they're in.
Okay.
And so folks find themselves just simply stuck. They're stuck on just one side, and they live their life through their retirement years, giving half their money back to the tax man. It's just a frightening nightmare that the majority of Americans are in that are in retirement today. So you have the baby boomers today, the wealthiest generation in the history of America for Black people in particular. And then we're retiring from the school system, from the federal government, from corporate America. We're taking these 401ks. You got these $1 million, $2 million in our bucket. And now we try to eat so we can enjoy life and travel and vacation. And then we get that check every month, that $5,000 check or $10,000 check every month. And but at the end of the year, when we file our taxes, we just get blown away that now we owe half that money back. So again, we simply find ourselves stuck. So again, it's very difficult to transition that money to the other side on the back end. There's some if you have some investment portfolios and you have some ways to offset some taxes through some business losses or some other kind of way, maybe we can talk about that. That's a discussion with your tax consultant. That's a discussion with your tax broker, with your CPA.
A question for you. Mm-hmm. All right, the internet's going in and out. We're having some things going on in the atmosphere. All right, so although you pay taxes on the qualified money, you still make money in the long run after the tax responsibility, correct? Or I mean, you're making money, but you're going to pay a healthy fee for that money you make.
Well, you certainly hope so. You hope that your portfolio, that your underlying portfolio has served you well. You can look at your historical performance from your portfolio and kind of see where you, what kind of portfolio that you have. Do you have a growth portfolio? Do you have a bond portfolio? I mean, it just depends. Large cap,
Or the
small cap,
cumulative portfolio. Yeah.
all the above. So hopefully you got your historical performance has been a blessing. And here you are today. Now you're getting ready to eat, and now you owe the tax man. But if somebody's under 65, for those folks who have 5+ years to retirement, they can try to catch up on the other side. So we're looking at those folks who are under 65 with at least 5 years before retirement or younger. And then those are kinds of folks that can look at putting some money together on the other side. And so you talk about that. And if you look at the left side, you talk about how, unfortunately, because of the tax system, your harvest can be taxed. It's going to be taxable. So many folks, unfortunately, find themselves about to run out of money. After 13 to 15 years, most of those dollars in your 401k are gone. And so you have those that, unfortunately, or if you had been on the other side, you had no investment losses. Again, understanding qualified versus non-qualified, also understand it in the market versus index to the market. Also understand investment losses versus no investment losses. Also understanding taxable income on your harvest versus tax-free income from your harvest. Understanding how your money can run out in 13 to 15 years versus having that money payable to you until age 100. Understanding how that money is uninsured, no protection, versus being insured. Okay, having that tax-free insurance death benefit for your family. Understand finding no bank financing. So we just have so many different things. We can have a conversation. We can have a whole show around each of these topics. But in the end, you either going to be self-funded or you're going to be bank financed. You're either going to work 25 years plus to get $1 million, or we can show you how to have to work only 5 years to get $1 million. There is so much information on the non-qualified side. The industries have merged. The banking industry and the insurance industry have merged years ago.
Yes.
So you can go to the bank and have them finance your retirement. Again, if you're 5 years from retirement, you're still in a good spot to be able to get $1 million, grow $1 million in your retirement account. So we just have no clue about understanding how to talk to a bank about financing your retirement. So that's a whole different presentation we can make maybe at another time. I would love to share that with you guys, how that industry has grown, how that right now is the #1 secret in America for business owners, for professionals today, bank finance, retirement planning. And so that's something we can talk about again, as I said, going forward. But right here, this is a story that we can share with folks on one page, how the two buckets work, and just understand which one do you prefer. So qualified or non-qualified, taxable or tax-free, in the market versus index to the market. So again, taxable harvest versus non-taxable. So these are just, again, information for them to review. This is how we try to show people how both buckets operate. So talk with your advisor. This is what we share with folks. And so again, this is still a story. So yes, there's still dollars that you can still make money. But again, you still attend, it's going to be taxable in life. And what most folks are not aware of, and those dollars are also taxable in death.
Yeah.
Most folks, it's just really, to me, have
state
no
tax.
clue. Not only that, but income taxes.
Income taxes, yeah.
Most folks are not aware that their highest tax bracket, they're not going to, you and I, we're not going to see our last tax bracket. We're not going to see our last tax return. Your estate, your family is going to file your last tax return.
Yeah.
Folks are not aware that their last tax return is going to be the highest tax return of their life. Wow. And so, unfortunately, rather than leaving that money to their family, a large percent of those dollars are going to go back to the tax man. Now, those are your qualified dollars. Whatever money is on your qualified portfolio, your 401k, often those monies oftentimes are going to be lost again when you leave this earth. Versus if those monies were non-qualified dollars through an insurance product, if that money was insured, that money would be tax-free to your family. So we simply do not recognize the power of insurance.
Mm-hmm.
So again, that's another story about how you grow wealth, and not only that, but how you grow generational wealth. So generational wealth is very crucial.
You know what? I love what you're saying. We teach that very much so with World System Builder about index universal life and indexed accounts, indexed life insurance, indexed annuities. We teach people very much. Now, a lot of people today are unfortunately too comfortable in their comfort zones and with the information that they had from years ago. And what a lot of people don't realize is that the finance industry, the insurance industry, the banking industry has evolved just like the cell phone, or just like that knife that we see there, the pocket knife, how it's changed from one blade now it has multi-purpose use. And so why don't you talk a little bit about that on the second slide, because protection is extremely important and valuable, and people have to understand that a 401k, a 403, a 457, it's not going to protect your money. Now, we did have someone one day share or mention that they were looking at their 403b and they were just reevaluating it. They're retired. They're retired already. All right. And what a lot of people don't understand is what you said earlier, the tax amount they're going to pay as they use that money. And then the other thing that's extremely valuable, and I'm so glad you said it because we said it before, is that the 403 to 401 to 457, although you may be earning some interest on it after retirement, that money is still going to run out because you cannot contribute to it anymore. All right. So why don't you talk a little bit about this pocket knife?
Well, before he does that, can we answer, or Cheryl Grant put up something just a few minutes ago, and we wanted to just make sure
we dealt with that. We dealt with that.
Oh, okay.
Yeah, you were gone.
I'm sorry.
Yeah, you were gone.
We certainly hope that she was clear about that.
Yeah.
Because the key there, of course, is your underlying portfolio. And oftentimes what we recommend to clients once they retire, you might have an aggressive portfolio when you was young, then a moderate portfolio when you got older. Then you go to retirement, you move that money to a conservative portfolio. So it should make money in the long run if you're getting proper advice and you have a strategy to protect those dollars. So again, that's all about your portfolio and your advisor getting the right advice. But here we are talking about another part, the financial pocket knife. We're talking about the IUL. We're talking about life insurance. And folks that we are not aware that life insurance has evolved. We're talking about the cell phone and how originally the cell phone was just for you to talk. And now your cell phone, you can text, you can do videos, you can do so many things with your cell phone today. You have flashlight on it. I mean, it truly has evolved. It's still called a cell phone. The life insurance policy has also evolved. And so historically, we've only used the life insurance for protection. And we need to understand that what is life insurance? Most folks have no clue. And they fail to understand what is life insurance. What is life insurance? Well, life insurance is just money. Okay, it's just money. And as we talked about the cost of money. So you can buy $1 of life insurance for 10 cents. So why wouldn't I have life insurance for my family if I can get $1 for 10 cents? And so again, $100,000 for $1,000 a year. So now bottom line is that I can then bottom line protect my family, and by using again the low cost of life insurance. Now, of course, that policy also has a cash value. And so understanding whether you can have that protection benefit for your family, protection to, of course, not term insurance. We recommend permanent, because we know that term insurance you can't buy term insurance, you rent it. So you rent that term policy for 20 years and then it expires and then you're back to zero. Versus that permanent policy that you buy, that you own, that you can be protected all the way to up to age 121. So we're talking about having proper protection. And then from that, you get tax-free death benefit, you bypass probate. Of course, then you have multiple type of settlement options. If you want to leave that money to them an income stream versus a lump sum or into a trust, then of course you get a feature now, a new day, then in today's dollar, inside your life insurance policy is another blessing. You got a living benefit bucket. That's a brand new bucket today that allows you to get that money if you get sick. Never before in the history of America have you been able to collect your life insurance policy while you're still alive. People don't know, less than 1% of America understands living benefits life insurance. The fact that your policy now will now pay you if you have a critical injury, heart attack, stroke, or cancer. That's a beautiful thing. Also, it'll pay you if you have a chronic injury. What's chronic? Chronic is that's a long-term care sickness. That means you can't feed yourself, or you can't bathe yourself, or you can't clothe yourself. How beautiful is it to know that your life insurance policy will give you a check? And so having those long-term care features is a beautiful thing. Or if you become terminally ill. So that's these features are the new features today. This is the updated life insurance. Most folks either have the old school or the new school. This is a new school type of life insurance. And so everyone should ask themselves, what type of life insurance do they have? Does it have the living benefit features to protect themselves if they become ill? So we know statistically, most folks are going to either die of some type of sickness if it's not an accident.
Right.
How nice would it be to have a bucket of money to have in the event of your illness? It's a critical illness or a chronic or long-term care type injury, or if it's a terminal industry. So that's just a protection side. But what has also evolved is a savings side. Most folks are not aware now. It's simply a new day in terms of how you use life insurance as a tax shelter. It offers you tax breaks that you can use your entire life. So the savings side, you have an interest benefit there, and that interest benefit historically was indexed to the bank. But today, that benefit side is indexed to the market. So now you can have that interest earnings inside your life insurance policy indexed to the market. You can have a stock index. You can have a gold index. You can have a real estate index. You can have a bond index. All these indexes allows you to grow money, and those dollars that you grow are all guaranteed. So what about having guaranteed interest inside your life insurance policy? Understand there's no downside market protection. You have a floor. So if the market falls, your interest rate stops at zero. Now, you didn't lose any money when the market fell, but more importantly, you didn't lose any. So we call that the floor. So index to the market is a way to grow money and have those interest dollars indexed to those different portfolios. How many folks got a gold portfolio? How many folks got a real estate portfolio from their interest earnings? How many folks got a bond portfolio inside their life insurance policy and a stock portfolio? So I'm just sharing with you, that's the way to build liquidity. So to have that interest, those dollars indexed to the market, and be able to access that money because you got those withdrawal options, and you got those tax-free loan options, and you got these favorable rates. You can touch that money anytime. There's no payback required. So all that money is just there for you to be able to protect your family and be able to build your retirement income, build your education income, to be have those dollar bills there for your family future. So all these tax advantages features that no one has shared with us, having that after-tax contribution, but getting that tax-free accumulation, and then having those tax-free benefits there, all with those tax-free distribution options, and none of those premature penalties. There's no minimum withdrawal options, and then to have all that money creditor protected. So again, this is just a new product in the marketplace. This IUL is now the number one product in America today. It is where you want to go to build your tax-free income bucket. So you should have your qualified 401k or IRA or 403b. You should also have your non-qualified IUL. And so now you can kill 3 birds with one stone. I don't know what they call that when you go shopping. My spouse said there's a name for it. When you go to the grocery store and you get 3 benefits for one. Bolo, Trollo, I'm not sure.
I don't know either. My wife knows.
Basically, today you have life insurance that give you multiple features. Why not get a life insurance policy that pays you 3 ways versus buying a life insurance policy that only pay you 1 way? Okay, so basically it's the same money. Basically, for most folks, it's just a matter of you having the right product. So do you want a 3-way life insurance policy, or do you want a 1-way life insurance policy? Simply ask my clients, which should they prefer for the same money? So again, this is on a non-qualified side. It's just a beautiful thing to talk about how you grow money, what kind of buckets are available, how that you can have life insurance that also pays you 3 ways. These are just strategies that the marketplace offers, and that are a way for us to use the tools that are available for us today. And then now we have a chance to truly understand the secrets of the wealthy. So life insurance is one of the things we're not aware of. Wealthy folks buy life insurance by the millions. Middle class Americans, we buy life insurance, by the hundreds. We truly do not truly recognize how to build wealth and how to build generational wealth and use the cost of money features you get when you put $1 in your 401k, costs you $1. Or after tax, it may cost you 70 cents after tax. I can get $1 life insurance for 10 cents. So 10-cent money versus 100% money, 100-cent money. So I'm just waiting for a way for you to understand how it may take me 30 years to build $1 million in my 401k. I can buy $1 million life insurance policy tomorrow. I can have $1 million for my family and still grow $1 million in cash value, and like I could in my 401k. The proper type of life insurance, the IUL, in my opinion, basically is a after-tax 401k on steroids.
I love it.
Anyone that does not have an IUL needs to fire their advisor. They have no clue of the wealth that they can be building for that low 10 cents on the dollar.
And you said so many good things. I love your everything that you said. I mean, I know your flyers. I just love it all. But before I go into my thought here, I need to get you to let me know, if you can today before you're gone, if you could come back next week.
I would love to.
Wonderful.
I would love to be able to show folks the banking side of how the banking side and the insurance industry have merged together, and understand how you can get a bank to help you finance your retirement using the IUL. So bank financing today for key man insurance or for the professional person, the doctor, the lawyer.
Yeah.
Today, anybody in America today, if you're not understanding how the bank will give you $3 for every $1 you put in, the bank will give you $3 to grow your retirement. So think about that. Your employer may give you a 3% match or maybe a 5% match, but understand you can go to the bank today and get a 300% match. 100%.
And now you can also do that dealing with certain insurance companies. Example, we offer IUL through Transamerica, through World System Builder. We have several companies that we deal with: Nationwide, Transamerica, Pacific Life, and we have around 100 different companies that we deal with. But those are three of the top that we deal with, and it's interesting how this golden nugget of wealth is hidden in plain sight. That's the thing that baffles me. It's hidden in plain sight. All right, and
very frustrating.
Pardon?
It's very frustrating in America.
It is, and I don't. As much as I love working with the people and showing people, people still question it and say, hold it, wait a minute. I never heard of this before. I'm not familiar with this. These are the words that I've heard. I never heard of this. Is this legit? If it wasn't legit, then these companies would be out of business.
Absolutely correct.
Go right ahead.
We are familiar with going to the bank and getting a loan to buy our house. We are familiar with going to the bank and getting a loan to buy our car. But we are not familiar with going to the bank and getting a loan to buy our life insurance and how that can be used through that's called premium financing. So I can buy $1 million policy or a $2 million policy and let the bank pay the monthly premium for me. In fact, they will overfund it for me. They will give me $3 for every $1 I pay in, and I can build $1 million in my cash value by using the bank's money.
All right, now hold on a minute. You said a couple of different things there. Get the bank's money, take out a bank loan, buy yourself a policy. You're going to have to talk about this some more, all right? And allow the bank to fund. And then you said something that we teach with World System Builder. We have free financial literacy workshops that we run online all the time. We run them online. They're free. There's no charge whatsoever. If somebody wanted to attend one of the workshops, they could do that, and they don't have to pay a thing. They don't have to pay a thing. All right, now this is what's critical about this is that when they use money out of that insurance policy, it's tax-free. The death benefit is tax-free. 401k, you're going to pay that tax. You're going to pay that. But here in the insurance industry, here again, that money tax-free. Mr. Clark, you said so many things. I couldn't write them down fast enough. I was too mesmerized by what you said to hear somebody talking the same language. Now, I need to ask you this question. Oh, wait a minute. We got a bunch of questions. We got a bunch of comments here. Wait a minute. Don't want everyone to know. Oh, this gentleman said this. He said this. He said it takes educating the masses, but you don't want everyone to know. I disagree with that. Not everyone's going to know, all right? But I disagree with you don't want everyone to know.
Absolutely. I disagree as well.
Yeah.
Unfortunately, we don't have proper advisors in our community. Most insurance advisors in our community only work with the wealthy.
Yeah.
For the middle class Americans, in particular middle class Black Americans, or white collar or blue collar Black Americans, we don't have any advisors to assist us, because most advisors, as I said, are working with the wealthy. So what we try to do, and what your company does, is offer this education for the middle class, for white collar and blue collar, so that folks can still get this information. Understanding that building wealth in America, okay, understanding leverage in America, understanding qualified versus non-qualified, taxable versus tax-free. These are things we need to know. That should be a part of our school system. Compound interest, we have no clue how to be a compound interest. We don't understand how to be indexed to the market versus in the market. And then for the top people, the high income professionals, we're talking about folks that make a minimum of $100,000 a year. Now that's a number, that's a good number, but it's not wealthy. It's not a wealthy number. But the blessing is today, if you have a 6-figure income, you can get access to these special programs and products that allows you to build wealth. And so I'm just sharing with you today, particularly in the industry today, how you can bring the bank, partner with the banking industry. So how many folks you know make $100,000 a year? Here in Metropolitan Atlanta, there's over 1 million folks that earn in excess of $100,000. Atlanta has over 6 million professionals, nearly.
Wow.
And so out of that picture, having a 6-figure income, you can take a PhD, a principal of your high school. He or she may be earning over $100,000 a year. Okay, you know, a college professor. You can have a small business owner, somebody that owns the local gas station can gross $100,000. So again, these are just numbers I'm sharing with you. But again, in terms of being eligible, your eligibility, it's a beautiful product. Understanding how to use leverage and how to use premium financing is just a tool. But if you got to self-fund, if you can only save $100 a month, you still need to understand how to grow money. And so you still need to be trying to put money away for your family. So a lot of clients, $100 a month will give you a $500,000 life insurance policy. Then you can have that cash value grow. Again, $100 a month can build $1 million for your child. If you put $100 away for education, you want to build an education fund for your child. So again, there's so many windows where you can use the IUL. I'm just sharing with you that we just simply need to be more knowledgeable. And I ask any and everybody, who's on your board? Who's on your board of advisors? Who's your board? Do you have a board?
Let me back this up a little bit. James Goodman said IUL is great in great times. It's good in a good market. That's another statement I disagree with. IUL is good regardless of the market, and this is why. You never lose money. You don't lose money. If the market goes flat, all right, then you don't earn anything. If the market goes below zero, you don't earn anything, but you don't lose anything.
A 401k is only good in a good market. What's a 401k in a bad market?
It's a loss.
It's a loss. Well, IUL has a guaranteed principal. So in a good market, yes, it does. It makes money. In a bad market, it protects your money.
Right.
So do you want to guarantee your principal, or do you want to lose your principal?
Ah.
Can you afford to lose your principal or not? So let's just look at the downside. Let's look at the negative. What's the worst thing that can happen in a 401k? You can lose all your money.
All of it.
What's the worst thing can happen to you in an IUL? You can only lose, you can't lose anything.
Yeah.
You may not earn anything. You sit there at 0%. You may not, you're not making any money, but more important, you won't lose.
You don't lose any money.
So we forget the guarantee. So again, it's just about your advisors. Who is your advisor? Who is sharing with you? And most folks haven't done their research. And I'm not saying IUL is the only tool. I'm just saying with you that it is a great tool, and it's a bucket for us that we can take advantage of, and it gives you many more features. So we need to use our monies wisely.
Yeah, one of the things that I try to tell, especially new parents, when they have their first baby, after I think you have to wait 10 days, 7 or 10 days. I forget now.
15.
10 days?
No, 15.
15 days, yes, 15 days. After 15 days, open up an IUL for that child.
That's
all right.
Correct.
And put in whatever you could afford. If you could afford $50, do it. If you could afford $100, do it. Because you said something earlier, you could overfund. Now, what's really valuable about that, what that means is this. Your premium, you're not locked into it. It's flexible. All right. Although they give you a set premium, all right, 50 or 75 or 100. All right. The way IULs are today, and we're running out of time. Oh, my goodness. The premium could be flexible, which means you could put more money in there. And before it becomes a modified endowment contract, the insurance company will let you know. All right, guys, we got to wrap this up. We are on seconds. Dr. Clark is going to be with us next week as well. And any closing remarks?
Well, just this. Once you know how much discretionary money you can put away, and that's the key. How much can you put? How much of your discretionary budget can you save per month? That will determine to a large extent which way you should go. So that's the key to understanding our clients. Unfortunately, most of us we run out of money before we run out of the month, and so we don't have any discretionary dollars to put away. Wow. And so finding that discretionary money is how you help people. So that comes back to how you are budgeting and what type of lifestyle and how you manage your lifestyle and managing your money. So money management is how you really help people.
Wow. Hey, guys, with that note, we've got to run. But as you see it going across your screen, share, like this, follow us, invite your friends and your family. This is extremely important. If you don't think this is important, then just look at your checking account or your savings account or your 401k. If you had a 401k during 2008, 2009, I know you lost some money. All right. I know I lost $10,000 and Lord knows that thing hurt. All right. So listen, people, this is a very important hot topic for the middle class, for folks who don't consider themselves to be anything, but you got some extra money because you're spending it over at Walmart and all these other places. But guys, thank you for being with us. We love you, and we're here because of you. My name is Anthony Murray. Dr. Clark, we're going to have you again next week. And folks, like us on Facebook and like us on YouTube. Thanks again. We'll see you next time.
Have a good day.